After some initial weakness, October was a strong month for markets, with global equities rising 4% and European bonds 1.9%. The ending of the US government shutdown and temporary resolution of the fiscal impasse in Washington contributed to the gains, as did a growing sense that tapering of QE3 could be delayed until the end of the first quarter next year, with the prospect of asset purchases under QE3 being maintained at current levels for longer, supporting both equities and bonds. While new deadline dates were established in relation to an agreement on the US budget for mid-January and with regards to the raising of the debt ceiling in mid-February, the risks around these dates and future fiscal conflicts should be considerably less than was the case in October. Opinion polls for the recent fiscal crisis showed large-scale disapproval among the US electorate regarding the closure of government activities and indicated sharp falls in approval ratings for those seen as most responsible for the closure and threatening to cause the US to default on its debt obligations. The failure to ultimately use the threat not to raise the debt ceiling, following pressure brought by leading global institutions and because of the negative consequences of such a move, probably now means this tactic will not be used in future political standoffs, and thus the new dates in early 2014 should provide less of a headwind for markets. Through October, the market's expectations regarding the start date for tapering of QE3 continue to be pushed out for a number of reasons. Economic data showed that growth in the US economy was slower than expected immediately prior to the government shutdown. The shutdown itself lasted longer than expected and led to delays and distortions in many key economic releases. Data that was released in recent weeks tended to be below expectations and suggested a negative hit to consumer and business confidence owing to the fiscal uncertainties. With fully clean data unlikely to be available until early December, the Fed would probably have insufficient reliable data which would enable it to determine the sustainability of the economic recovery until the first quarter of 2014. The nomination of Janet Yellen to replace Ben Bernanke as the new Fed chairperson also impacted market expectations relating to QE3 tapering and monetary policy. Yellen is perceived as having a monetary easing bias, and in public speeches has indicated a focus on the need to improve the labour market and lower unemployment and tailor monetary policy to meet this goal, even at the risk of slightly higher inflation. As a result, the market's perception is that monetary stimulus in the US will be kept at a higher level and for longer than previously would have been the case. While global equities have risen almost 23% year to date and are up almost 18% in euro terms, equities still offer upside into 2014. Valuations are still below historic averages, and equities remain particularly attractive compared to other asset classes. While economic data was somewhat softer through October, data in early November has picked up again, with a key leading indicator, the Global Composite Purchasing Managers Index, reaching a 32-month high. The continued support from monetary stimulus, which is facilitated by continued low levels of inflation and confirmed by November's 25 basis point reduction in interest rates by the ECB, underpins equities, and combined with evidence of improving fundamentals, provides support for further gains in equity markets in 2014. While global bond yields have fallen with tapering of QE3 delayed, the improving economic backdrop, which should provide more evidence of recovery in 2014, together with the ultimate beginning of QE3 tapering, should cause bond yields to continue to move higher over the next 12 months.